Thanks, Carolyn. There's been a concerted call for Aussie investors to go longer international equities, and Paul Moore of PM Capital is a believer, and we'll see why. Welcome, Paul.
Thank you.
Before we start, Paul, I know you're an advocate for international equities, but what's your feeling? You've probably heard Michael Knox talking about the Greece possibilities, and what's your view on the international scene when it comes to stocks?
Look, basically longer term we're still positive on stocks. I mean, the one thing that people need to be conscious of is that the return you get on owning a business is still well in excess of cash or bonds or property. So to be honest, we still think it's probably an abnormally high margin. Now, markets have done well short term. Most markets are at their highs, so the reality is you're probably going to get some digestion.
Digestion, you mean like volatility or convulsion?
But I don't think it's going to be extreme.
No.
But the reality is the earnings cycle is still in the early stages offshore, and that's what's distinguished versus what we have here in Australia. So even though the valuations have adjusted, you're now going to get into what I would call a typical market where it's earnings growth, stock picking that's really going to drive things.
Yeah, it's funny you should say that. I was just looking at HSBC, which of course is now the biggest bank in the FTSE. And their all-time high was about 798 pence, and they're around 622. So they're a long way from their all-time high. Sure, they've had their challenges, but usually a company will pass their old all-time high, won't they?
I think in this environment, when monetary stimulus has been so good, and actually HSB is interesting because it's missed the recovery in banking stocks offshore. But I suspect we've actually been starting to do a bit of work on it, and I think all those negative issues are now finally starting to get behind it. So it's actually one to have a look at.
And also the UK economy is a fairly impressive one at the moment, isn't it?
It's stronger than people realise. We actually just came back from Europe, and the one thing that surprised me on the strength side of the economy was London. London's a lot hotter than people realise.
Getting back to normal, which was out of this world, wasn't it?
Well, it is back to normal if out of your world is because it is very, very strong. People don't realise it.
Prices and things like that. Okay, so you're just tell us about PM Capital, because you've got a strong, you advocate strongly international equity. So tell us about PM Capital.
PM Capital is pretty simple. Basically, we're out there looking for opportunities that we think are mispriced on a medium to longer term, so 3 to 5 years plus. We're basically old-fashioned stock pickers. We search the world for the anomalies.
And you're a fund?
We're a fund, We have an unlisted fund and a listed fund. Our heritage has been global, but we also have Asian and Australian funds. But basically, we kind of see it as a global village has been for a long time. So we don't like to tie ourselves down to particular geographies. Just find the best businesses when they're being mispriced for sort of cyclical reasons that the market is starting to price as permanent, when the reality is they're transitory.
Okay, so a lot of my viewers watching the show is saying, okay, it's great to see the argument to be diversified, but have I missed the boat? You've mentioned, I've mentioned, well, there's markets at all-time highs. What's the argument that they can go higher?
I think, provided you've got the right time horizon, I've got no idea what's happening next month or the next 3 months or the next 6 months.
Gee, that's bad. Why did I invite you on the show, mate? I want people who can tell me that.
I wish I could. But bottom line is when you look overseas, you get a much better breadth of opportunity. So there's more to choose from. We think the currency is going to continue to depreciate. It has come down the last 12 months pretty rapidly, particularly the last 6 months. But typically when these trends turn, they don't last 12 months. They last 5 to 10 years. So currency is going to be adding to your stock returns over time. And the bottom line is when I look around the world, if I find a business here in Australia and a same business, similar dynamics offshore, typically offshore it's 20 to 30% cheaper. So those dynamics are still there. And as I said, these trends don't tend to last for short periods. So we think the outlook in favour of international stocks is probably going to be that way for the next 10 years.
Okay. Now, I know you've talked about examples of looking at, say, Wells Fargo and comparing it to CBA. Talk us through that one.
The reason we use that is because it's so simple, because they're such similar businesses. And it's something that should resonate with Australian investors, because if you look at what's happened in banking, that they're all made so much money out of the last 20 years. Started with the property crisis back in 1994. Westpac nearly went bust. It created a situation where all the banks started to focus domestically. Imputation came along favouring higher payout ratios, and the more they put payout ratios up, the more they were re-rated, And that's culminated until recently where these stocks were selling at 15, CBA, Westpac were selling at 15 PEs, which are the highest absolute banking PEs in the world.
Yeah.
That story has finished. But the beauty of offshore is that that story is only beginning, because you had the GFC, property crisis. As a result, all the regulators said to their banks, we want you to focus on domestic. Now that they've addressed the non-performing loans in their balance sheet, they're starting to increase their payout ratios. So Australian investors already know what's going to happen. The stocks are going to get re-rated.
Yeah.
And the beauty is, over the last 12 months, you've been able to buy the equivalents of CBA around the world, whether it's Wells Fargo, Lloyds in the UK, ING in Europe, Bank of Ireland.
That's a curveball.
They dominate their market now. They earn great returns, high margins. And we were buying these companies on half to a third of what CBA was selling for.
Yeah.
So it was almost a no-brainer. And as I said, it's only just started, so you've got probably 10 years of rising payout ratios over there. So you can play the same story again.
So payout ratios, my viewers will be saying, do you mean that you can expect higher dividends from these companies?
Exactly.
Because at the moment, you look at US dividends, like, come on, look, we don't get the same, for the last few years, low dividends compared to us.
Yep.
And there's no imputation credit, no franking credits.
Correct.
But you're saying that over the next 4 or 5 years, you expect Wells Fargo, as an example, would be a much better dividend payer.
Wells Fargo was already flagged for the next 12 months a 75% payout ratio.
Yeah.
Now, you get part of it in buybacks, so it's not as obvious, but the actual yield you're getting is probably going to be the equivalent of 6%. And remember, bond rates over there are lower than Australia.
And you would throw in the currency benefit as well.
And the currency.
All right, Paul, well, you've been pretty persuasive. If you're wrong, we're going to hold you responsible. Thanks for joining us on the show, mate.
No problem.
That's Paul Moore from PM Capital. So after break, we'll test out the expert opinion that buy and hold does not necessarily work.